Most people who invest in cryptocurrencies do so for one purpose: to make a profit. There is nothing wrong with that. In fact, the reason for the emergence of the first cryptocurrency, Bitcoin, is the bad financial system we live in. Inflation is soaring with the numbers so high that you need to be above 40 years old to have seen it before. In such an environment, money is losing value, and the best thing to do is to invest it and earn a profit. If you are already doing that, this video will teach you when is the best time to sell your crypto and how to take profits from your cryptocurrencies with 3 best exit strategies. So, in order to take profits in crypto, you obviously have to make profits first. When your crypto is up from your initial investment, you can choose to sell it or continue holding it. It all depends on what kind of investor you are and the conviction you have in your cryptocurrencies. There are 2 types of investors: active investor and passive investor. An active investor can be a day trader, which is an investor that buys and sells crypto in a single day. A trader relies on the momentum and short market insights. For a trader, it is important to sell crypto profits every day, and he will do so using predetermined buy and sell orders. The second type of active investor is a short-term investor. A short-term investor is a type of investor who is looking to catch a train. You probably know that market moves in cycles, meaning there are bull and bear runs. If you have ever experienced a bull run, you know how fast the market can grow. Short-term investors are looking to take advantage of those cycles, and they are taking profits when the market loses its bull run power. Passive investors are long-term investors that are almost never selling their positions. They have a long time horizon when it comes to their crypto, and they choose to sell cryptocurrencies when they think a certain cryptocurrency is overvalued. After making a thorough analysis, they sell crypto that is overvalued and invest back in when it comes down to its fair price. Okay, so what are the best strategies when taking crypto profits? The first one we are going to cover is DCA out. DCA stands for dollar cost averaging. It is one of the most popular techniques to buy cryptocurrencies, but also it is a great selling technique. It basically means that you sell your crypto in a few instances instead of selling everything at once. You already know that the best time to sell your crypto is when that crypto reaches the top. However, nobody knows when the top will happen, and it's pretty difficult to predict it. That is why dollar cost averaging is an awesome strategy. When you decide to sell your crypto, you simply divide your position into several parts and sell it one by one in some period of time. For example, you may want to sell 1 Bitcoin. You would divide your Bitcoin in, let's say, 5 parts and sell 0.2 Bitcoin each week. In 5 weeks, you would sell all your Bitcoins and your selling price will be the average of those 5 weeks. This strategy is used by short-term investors that are trying to sell at the top of the bull market, but also by the long-term investors that are trimming their position. The second strategy when selling crypto is reaching a goal. This strategy is mostly used by traders that are going in and out of the position in a single day. So whenever a trader starts a position, he is using sell limit order below the buying price in case he is wrong, but also sell limit order above his buying price when his goal is achieved. That goal can be set by the potential of the pump or simply by the return that satisfies the trader. In any case, traders usually use limit orders to implement this strategy, and they set limit orders by analyzing support and resistance levels. Support and resistance levels are basics of technical analysis, and if you want me to do a video explaining technical analysis, write it down in the comments and I'll happily do it. Reaching a goal can also be used by passive investors. Many people started investing in crypto with a specific goal in mind, for example, to buy a house or a car. When you have a goal in mind, it is pretty straightforward what you need to do. After you have reached your desired amount, you would just sell your crypto. The last strategy I will cover in this video is taking out the initial stake. That strategy is often used when investing in small cap cryptocurrencies that are relatively more risky than large cap cryptos. When you reach a certain profit, you would sell the initial stake you invested and leave the rest of the coins in your portfolio. With this technique, you're certain that you won't end up with a loss and you can reinvest your initial stake in other projects. Taking out the initial stake is a strategy used by short-term investors that are catching the trends in the crypto industry. Many times, one part of the industry, such as NFTs or the metaverse, experience rapid growth and the short-term investors love to do rotations in their crypto portfolio to catch those trends. If you're a long-term investor like I am, you will not bother with market volatility and you will sell your crypto profits only when the project changes fundamentally. That means that you understand the project you are investing in, and if that crypto project starts giving poor results, that is when you sell your crypto profits. So, if you are new in investing, be sure to set your goals and decide what kind of investor you want to be. There is no right or wrong type of investor. It just depends on the risk you are willing to take and the effort you are willing to put in. I hope this video made taking profits in crypto more clear to you. If it did, it would mean a lot to me if you press the like button and share it with your friends. See you in the next video.